AI bank reconciliation in Xero promises faster month-end with automation and human review. It can streamline matching while maintaining oversight. Here's what to consider before switching it on. Because I wonder if it is a good thing. As a bookkeeping mentor, I have seen enough revolutionary tools to know that efficiency without control is a false economy. So the question is whether the new AI bank reconciliation in Xero genuinely elevates the monthly close or simply shifts risk out of sight. The attraction is obvious: low-touch background matching and a cleaner to-do list when logging in. Yet the sensible approach is to separate speed from governance. Automation is compelling when it reduces repetition. It is unacceptable when it quietly rewrites the audit trail. The stakes are practical: cash accuracy, VAT integrity, and client confidence. So the lens must be clarity, not hype. A credible path starts with configuration discipline. Keep automation off by default and introduce it client by client, bank by bank. Define which transaction types are eligible for automatic reconciliation and which must be reviewed manually, such as refunds, director transactions, intercompany items, and anything involving suspense. Establish monetary thresholds in pounds sterling that suit each client's materiality, because £50 noise in a cafe ledger is not the same as £5,000 noise in a construction firm. If Jax, the Xero AI, proposes a match, the rule should be the system moves first only where probability is high and the impact is low. Everything else queues for human review. My main concern is that automatic posting without human input could normalize silent errors. The countermeasure is sharp observability. I expect an exceptions feed that is concise, sortable by risk, and auditable end-to-end. Every automated match should retain evidence: bank line, source document or pattern signal, confidence score, and the user action that trained it. If learning is claimed, the learning history must be visible so bookkeepers can approve, roll back, or quarantine it. With that transparency, automatic becomes explainable, which is the minimum standard for month-end sign-off. A phased rollout protects both your books and your bandwidth. Start with a narrow scope, such as recurring subscriptions, bank fees, and payroll outflows, where narratives and amounts are consistent. Observe a complete month-end cycle, measure the delta in outstanding items, and compare the error rate against your current rules-based setup. Only then expand into more ambiguous areas like supplier refunds or multi-line receipts. This controlled exposure builds evidence that the team can trust, rather than hope, that the model behaves in line with policy. My final observation is cultural, not technical. Both bookkeepers and their clients are more likely to accept automation that defers to them. If Jax proposes and the team disposes, confidence grows. If it posts in silence, resistance hardens. The optimal setup gives complete flexibility to pause, adjust, or take over any transaction without friction. In that frame, the question is not whether AI replaces expertise, but whether it amplifies it by clearing the undergrowth so judgment can see the ground. A cautious yes is the honest conclusion. With careful scoping, visible controls, and a review-first operating model, AI bank reconciliation in Xero can shorten the monthly close without sacrificing oversight. I'll enable it as I need to know how to use it, so I can pass that knowledge onto my own clients. But to start out, it will only be for transactions where my confidence is high. I'll let evidence decide whether AI bank reconciliation in Xero becomes the new baseline. If anything I've written in this blog post resonates with you, and you'd like to discover more about AI bank reconciliation in Xero, it may be a great idea to give me a call on 01604 42057, and let's see how I can help you.